Fed Chairman Jerome Powell may be about to accelerate interest rate hikes and in so doing crash the entire economy. The stock market's falling sharply, safe haven buying for gold is ramping up, and this is all happening at a time where US savings and personal debt amounts are at their worst levels ever. Are we seeing the early signs of a massive recession or financial collapse? I'm Biko Konstantinos, and that's what we're going to talk about today. I'm here to serve you with the best financial content I can provide, and subscribing to my channel would help me continue improving the quality of my content. And if you enjoyed this video, make sure you give it a like to really help the algorithm. Now back to Powell. This is what Powell had to say at the latest Senate Banking Committee hearing. The latest economic data have come in stronger than expected, which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated. If the totality of the data were to indicate that faster tightening was warranted, we would be prepared to increase the pace of rate hikes. Did you get that? Increase the pace? Rates have already gone from near zero to just under 5%, and that's all since May 2022. And now they're talking about potentially increasing the pace again? What's been the major theme regarding inflation and interest rates from the Federal Reserve and other central banks around the world? They got it way bloody wrong. Initially, the Fed told us that inflation was only transitory. That means up for a bit and then down. Then we were told it was Putin's fault. After that, inflation was only due to supply chain shortages. So we had all of that, but inflation still remains highly elevated. And now the Fed, after slowing down their interest rate hikes, is talking about potentially going hard again, as in lifting rates by 50 basis points if required. Considering the markets and the economy haven't really absorbed all the interest rate hikes so far, some oversized interest rate hikes now could put a sledgehammer into an already weakening economy. Traders now see the Fed funds peaking at 5.64%, which is much higher than the 5% level projected just 1 month ago. So we're beginning to see a pattern here. Initially, everyone expected the Fed to pivot probably around mid-2023 and then start reducing rates. But that's looking more and more unlikely as the realization sets in that inflation isn't just going to drop back to super low levels. It might be dawning on the Fed and other central banks that they might actually have to destroy their economy to get inflation down. In other words, they're going to have to send their economies into recession. So because of this hard landing recession risk for the economy, stock markets around the globe have been falling. The S&P, which has been falling since the highs of 2022, looks set to start a new uptrend in early 2023. However, recent trading has seen the S&P fall back again. Now, considering the S&P has fallen back down below this downtrend line here, this upward breakout could actually turn out to be a bull trap. Now, a bull trap is when the market looks like it's going to start a new uptrend, all the bulls enter new positions because they think it's going up, only to be trapped because the price quickly collapses again. Looking at the longer view chart of the S&P 500, we can see all the wild speculation that happened after COVID due to all the economic stimulus pumping money into the economy, paying people to be locked down, and reducing rates to zero. We saw this ridiculous speculative bubble over nearly every asset, and now we're starting to see the after effects. It's like the come down after a massive bender. Yes, the bender might be fun, but the come down could be brutal. And that's why I think we keep getting these surprise shocks, because you can't lock down an entire global economy, go ultra loose, and expect there to be no consequences. The same sort of weakness is also happening with the Dow Jones and the Nasdaq. Now, we've also seen a little spike in the VIX index, which measures the volatility of the stock market, but as you can see, volatility is still relatively low, because back here when the stock market was rising, everyone expected a new uptrend to commence and were hoping to avoid a recession completely. But volatility could very quickly ramp up if economic indicators start to deteriorate. Now, we've had previous interest rate hike cycles and the economy worked out fine, you say? But this time, one major difference is the extraordinary levels of debt in the wider economy. The US national debt is now heading towards 32 trillion. Now, just have a look at the US interest payments on its debt. Since the COVID spending, interest payments are basically going straight up, and soon interest payments will be about 1 trillion per year. So the Federal Reserve simply can't raise interest rates forever because their interest payments on their massive debt would basically cripple the government's budget. So they're currently in a massive bind. But what about consumers? Well, after COVID, personal savings rates spiked due to the lockdown and stimulus payments, etc. But look what's happened since then. With cost of living skyrocketing, personal savings rates have basically collapsed. Perhaps even scarier, check out the levels of credit card debt in the US. Yes, they fell after COVID, but look what they've done since then. So we've got record levels of credit card debt at a time when interest rates are surging. That's a problem. A big problem. Just check out some of these stats. The US has 16.5 trillion in household debt, 11.9 trillion in mortgages, 1.6 trillion in auto loans, 986 billion in credit card debt. The total mortgage debt now is more than double what it was in the 2006 peak. Shockingly, 36% of Americans have more credit card debt than savings. That's more than a third of all Americans. And like we said, interest rates are surging and Powell might just be about to put the accelerator back on. Is this gonna end well? Now, all these economic concerns aren't isolated just to America. It's basically the same across all advanced economies. Because they all followed the same ultra-loose monetary policies during COVID, the entire global economy is facing the same consequences, and as a result, the same risks. We've seen countries like Lebanon and Sri Lanka facing economic collapse. We've got geopolitical tensions. We've got the war between Russia and Ukraine, but also other geopolitical tensions with China and Taiwan, the BRICS nations trying to step away from the US dollar, and things like that. So amidst this backdrop of global turmoil, we're now starting to realize that interest rates could be higher for longer, which will have a massive effect on global economies where debt levels are so high. Consumer spending is about to collapse as all the savings accrued during the COVID lockdowns are all spent because of higher costs of living. And guess what? When consumers don't spend, companies' profits fall. And when that happens, unemployment starts to rise. And that's when recession will hit. And it could hit hard. And we're not talking about recession for one country. We're basically talking about the entire globe. Can this end well? I'm Biko Konstantinos.